the opposite of. And this is could be, I think you wrote a blog post about this, Chamath, sort of the regime change. If you look at the Googles, the Facebooks, the Apples, Amazon's is a little bit of an exception here. Those companies printed money. They had profits. They built up large cash reserves. If we look at the next cohort of companies, Airbnbs, Coinbases, Ubers, et cetera, they focused on the top line growth, much like the Amazon, which was a very obscure approach, correct, Chamath, in the history of this?
Nick, do you want to just throw up this chart? We did a little analysis over here, and it was just basically looking back 60 years of company formation. We looked at all of the 100 most valuable public company startups, and we indexed that to the 10-year interest rate.
So what are we looking at here, Chamath, with this chart?
So basically, we went back from 1960 onwards. So basically, 63 years. And what this shows you is the 100 most valuable public technology companies. Then the size of the circle here is their market cap. And then it's overlaid on top of the 10-year interest rate, as well as gray bars for recessions. So what is this graphic meant to illustrate? Well, it just was for us to study, is there a correlation between the value of companies and what the interest rates were or what the economy was doing at the time? And to your point, Jason, the trend is pretty starkly made on this chart, which is that if you are a company that was founded in a period of austerity, you had the ability in general to build a much larger company than that which was founded in a period of wealth and excess, right? So when you look at when rates were sort of approaching zero or were zero, there was a lot of really successful companies. They're listed here in the light gray on the right, but none of those things really represent the success that these other companies had. That's the first interesting takeaway. The second interesting takeaway, though, from this has nothing to do with rates per se, but it is that when rates intersect with the emergence of huge technology trends, so in the case of the 1970s, it was the PC revolution. In the case of the late 1990s, it was the internet revolution. Those two things, which required enormous progress in both physical infrastructure, so atoms, as well as software infrastructure, bits, when you put those two things together, those also created big companies. And so if you add that all up, the point is that whenever you see huge tectonic shifts in technology combined with periods of austerity, that's when the gargantuan dollars are made. So in the 1970s, companies like Microsoft and Apple from the get-go had to be profitable, right? And in the absence of one very important round of financing that Amazon was able to close, the next big wad of companies were founded again in rising rates where they just had to get profitable or find a way to be positive free cash flow or have positive working capital faster than anybody else. So these are like really interesting trends that I think just say that as rates creep back up, and if we can intersect that with some improvements in technology over the next 5 to 10 years that we've all talked about, it could be a real boon for startups and startup investing.
It would mean people are a little more resilient, a little more hardcore, to use a term. Friedberg, what are your thoughts on this analysis by Social Capital?
It's interesting. I mean, I think there's probably two ways you could interpret this. One is in an era of excess capital, all the capital gets competed away. And so you pay more salaries, you have, it's harder to get high quality talent, you make a lower margin, et cetera, et cetera. It's much more kind of competitive on the ground. And then another one is just obviously kind of like evolutionary fitness. When there's less capital, investors are more selective. I think what might make this era a little bit different than the past is just the amount of termed dry powder sitting on the sidelines right now. So the total VC capital raised last year, I think, was a record high. That means there's a lot more cash that needs to kind of be deployed in the next 12 to 36 months than has ever been deployed in the history of venture, if that holds true. So that may be kind of a counterbalancing effect here, where it may take 3 years before that effect plays out, where there's more of a dearth of capital. It's certainly the case that institutional investors, endowments, pension funds, traditional family office LPs, and venture funds are making far fewer commitments this year to new funds, as I think we all know. And that tightening will play out in the venture funds that'll get raised for this vintage, the next vintage, and so on. And so maybe that kind of evolutionary fitness concept starts to play out later.
And sizing. And sizing.
And sizing. I think there's also this we talked about this on our text stream, but the venture business of the last 15 years, everyone since 2008, everyone's been trained, and all the younger people that have come up and are now partners and running the firms on an environment of momentum investing rather than fundamental investing. And so there is also a question of how fit the investors are for a market space where valuations are flat or descending, or the decision whether or not to invest is no longer driven by who else is investing and how much is the company growing and how much is their valuation going up. But it's much more about kind of the fundamental performance of the business.
Does this match what you're seeing on the ground, Sacks? Are people being more dogmatic, pragmatic? Are the capital allocators really sharpening the knives and looking at these businesses a different way? Is it actually hit the streets?
Yes, there's a record amount of money venture capital has raised over the last couple of years, but it's going to be deployed much more slowly and carefully over the next, say, 3 or 4 years than it was over the previous few years. So divide that amount of money by 3 or 4 because the pace of deployment is going to go way down. And so, yeah, I think people are going to be more careful. They're going to take longer to make decisions. I think it's going to be much, much harder for new funds to get started. All of the, hype around, solo capitalists and, all these, seed funds and micro VCs and all this kind of stuff. I think a lot of that's going to get washed away. I think in hindsight, a lot of that was a product of the bubble. And yeah, I think you're going to be in for a period of some retrenchment in VC. And I think that's good. I mean, I think to the point of Chamath's study that, that the counterintuitive finding in his study was that great companies are created during times when we're not in a bubble and capital is sloshing around everywhere, but when you're in an environment of moderate capital availability. And I think the point is that we all have to be under some stress, right? That's what evolution requires is, if an ecosystem or an organism is not under stress, they have no pressure to evolve and become fitter and compete. And I think that's what makes our industry and our ecosystem very adaptive over time, is that it's constantly, it does face survival pressures. But over the last several years, all the survival pressures were taken away because anybody could raise money. And
there was always another bridge available. There was always some extension, and there was
some convertible
reckoning.
note to be done.
Right.
There was no reckoning. A lot of these companies just seem to, get another 12 months of runway, another 12 months of runway.
Founders learned so many bad habits during that period of time, and so much entitlement and excess built up in the system during that time. And I think now we're seeing that a lot of that is working its way out. I mean, just look at the Facebook results the other day.
So Facebook,
let's talk about Facebook as an example, because here you have a company where the stock over the past year had been pounded. It was like down over 50%. And the market
$90 a share,
the market did not like its answers around the capital investments it was making. And then Brad Gerstner, our friend, wrote that letter encouraging them to get much more efficient. And then they did that. And they basically started doing some riffs and basically just getting much more efficient in what they're doing, and specifically taking out layers and layers of middle management. I mean, that was really the big thing. So they kind of took a page out of Elon's book in terms of what Elon had done at Twitter. I mean, not nearly to that extent, because I don't think they needed to, but they targeted this idea of we have too many layers in the company, too many mid-level managers. And the stock ripped just, was it like up 20, 25%?
Yeah, in a day.
Yesterday.
And
in a day.
They're up to, I actually bought it the day they had the layoffs. I put in a buy order and it was closed at $94 and now it's at $193. And FedEx, of all places, is laying off 10% of its officers and directors. So the idea now is, hey, in the senior ranks, what is the inefficiency there? How do we get more doers, more people who actually are building or operating the companies to take the reins and get rid of this, as you're saying, middle management, this waste? that companies have.
Let me tell you specifically the problem that builds up in these companies is that everybody wants to be a manager. And so you can't just come at this problem by saying we're going to increase the number of reports that each manager has from 5 to 10. That doesn't work, because let me tell you what happens is that every individual contributor who's a star thinks that their career advancement requires them to manage a team. So what happens is you take that star IC and then you create a team around them. So that person then hires 5 people to manage. And those
then
5 people are not star. Yeah, they stop working. They just start managing. Yes. Well, maybe you get like 20% more production out of that 6-person unit than you would have just out of the star. But you're spending 5 times more money. So it makes no sense. And the problem is it cascades. So, that IC becomes a manager. They hire 5 people. Then those 5 people, one of them's a star and says, well, I want to be a manager. And all the organizational pressure is to keep building more and more teams and more layers.
Here's the quote from Mark Zuckerberg to illustrate your point from a recent all-hands meeting. I don't think you want a management structure that's just managers managing the people who are doing the work.
Yes, it's the problem of infinite delegation. Every star builds a team around them to delegate the work, but then they hire a team to delegate the work to. And pretty soon the most junior interns in the company are doing all the work and all the best people are just managing. So it's actually a huge problem. And I think that I'd say that a lot of CEOs don't quite understand the problem because they think that all they have to do is increase the number of reports that managers have. It's not. You also have to reduce the number of layers in the company. And just the ultimate example of this, just to put a point on it, was at Twitter, what we saw is that when Elon went in to basically do a riff at Twitter, the first question he asked in the engineering department is, who's checked in code? And they looked at the code repository, and over 50% of the engineering department had not checked in code in months. And you want to know the reason for that is because the engineers were told that if you want to be a manager in this company, you don't code. Managers don't code. Only ICs code. And no one wants to be an IC. No one ambitious wants to be an IC. They all want to get promoted. So it all gets
Explain what an IC is.
Just individual contributor.
Yeah.
So the whole thing turned upside down because of this idea that, again, ambitious people want to be managers and managers don't do the real work.
Yeah, it's a cowboys who don't know how to ride horses. It's a dangerous precedent to set. What are your takeaways, Chamath, from what happened at Facebook when you look at it and the pressure that was put on the ripping of the stock, even though they're down 2% year over year in terms of advertising revenue?
There's a guy on my team sent me this chart. He did a pretty detailed technical analysis of Facebook. Nick, can you please put that image up there? So basically, this shows
this is really technical.
This is the first time Facebook mentioned the word metaverse. In Q2 of 21, on the earnings call, they mentioned it 20 times. Yeah. And the gray line here is the stock price. So as they kept mentioning it, the stock price just reacted as it did. But Q4 of 22 was the first time that the word efficiency exceeded the word metaverse, and you saw the stock price rip up. So what's happened at Facebook is really interesting because I think it transitioned to what's generally called an ex-growth company, which means that people are now looking at a business that has essentially gotten to its peak size, and now what they're looking at is its ability to generate cash flow. The cash flow generation or cash flow yield of the business was like 3.5%. But they're making enormous cuts, both in CapEx as well as headcount over time. They're getting their expenses under control. And all of that should drive up their free cash flow yield. And so I think why people got very excited is there are very few ex-growth stocks that you can own that can just compound and crunch ginormous amounts of money. And these guys are in an incredible position to do it, more than $100+ billion of revenue. And if you get these costs under control and get efficient, get the employee base down to 30 or 40,000 over time, this is a thing that just spits out just ginormous amounts of cash. And so it's
back
really
to value investing and Warren Buffett, that means the earnings per share go way up.
Yeah, like the Facebook PE is quite modest, actually. Now, I actually put back in stock-based comp, and its PE is about 11.
So still reasonable.
If you go back to the Ben Graham analysis, this is a company that perfectly meets that criteria of you can buy it at a PE That's basically 2 times the risk-free rate. And so I think it's an incredible stock now that you can own. Because if they keep grinding out all of these kind of free cash flow gains, man, they'll just have enormous amounts of money. They already announced a $40 billion buyback. The thing to keep in mind is Apple had a moment like this. And when Apple went X growth, they did the brilliant thing, which is they said, we're going to borrow heavily and we're going to return cash. I may have posted this in the group chat to you guys. By 2025, Apple will have exceeded $1 trillion of cash distributions. I mean, that is just nuts.
Does that include buybacks in cash distributions?
Buybacks and dividends. And so Facebook now, you can credibly see a path where Facebook could chunk out hundreds of billions of dollars of total shareholder value returned over the next 4 or 5 years. And so, for value investors, it's somewhat of a kind of a no-brainer. I mean, nothing's a no-brainer, but
yeah,
really, really attractive value fundamentals right now.
I mean, you did see Warren Buffett buying Apple. I think it's his largest position. You're going to see him probably do the same with Facebook.